Imagine you have $10,000 that you want to grow. How can you turn it into $160,000? The secret lies in compound interest and a simple mental math trick called the Rule of 72. In this video, we'll break down how money grows over time, so you can see exactly how $10,000 can become $160,000 down the road. First, let's talk about interest and compounding. When you put money in an investment like stocks, bonds, or a savings account, it earns interest or returns. If you leave that interest in the account, your balance grows faster and faster over time. This is compound interest. You earn interest not only on your original $10,000, the principal, but also on any interest it has already earned. Each year, your money makes more money on top of itself. This interest on interest effect is what makes compound interest so powerful. In simple interest, you'd only earn interest on the $10,000 principal every year. But with compounding, year one's interest gets added to the principal, so year two's interest is calculated on a slightly bigger amount, and so on. Let's make that concrete with numbers. Say you earn 10% interest per year, which is roughly in line with long-term stock market returns. In the first year, 10% of $10,000 is $1,000, so at the end of year one, you have $11,000. In the second year, 10% of $11,000 is $1,100, so you end up with $12,100. After year three, 10% of $12,100 adds $1,210, giving $13,310. You can see how each year's interest payment gets a bit bigger because it's calculated on a growing balance. Over many years, these gains accumulate and the curve steepens. Compound interest can make your money grow much faster than with simple interest, especially when you give it a lot of time. Now, if we want to know how many years it would take for your money to double at a given interest rate, we can use the Rule of 72. The Rule of 72 is a simple formula for estimating how long it will take for an investment to double in value with compound interest. Here's how it works. You take the number 72 and divide it by your expected annual interest rate as a percentage. That tells you the doubling time in years. For example, if your investment returns 8% per year, you'd do 72 divided by 8 equals 9 years to double your money. If it returns 10% per year, 72 divided by 10 equals 7.2 years to double. It's a handy mental math shortcut that's pretty accurate for interest rates between about 6% and 10%. So why is the Rule of 72 useful? Because doubling your money is a big milestone. Once you know how quickly your money doubles, you can see how it grows over multiple doubling periods. To turn $10,000 into $160,000, you need it to double 4 times. Here's a scenario. Imagine you invest $10,000 in a broad stock index or some other investment averaging about 10% per year. Using Rule of 72, it takes roughly 7.2 years to double. That means by around year 7 or 8, your $10,000 becomes $20,000. Another 7 years, around year 7, it doubles again to $40,000. By year 21, it would be about $80,000. By around year 29, it would reach $160,000. In this example, starting with $10,000 and compounding at about 10% annually, you could have roughly $160,000 in about 29 years. Let's see another example with a more conservative return, say 8% per year, which might be closer to a realistic long-term return after inflation. The Rule of 72 tells us 72 divided by 8 equals 9 years to double. That means after 9 years, $10,000 would be $20,000. Then after 18 years, $20,000 would be $40,000. Then after 27 years, $40,000 would be $80,000. Then after 36 years, $80,000 would be $160,000. So at 8% annual returns, it takes about 36 years to grow $10,000 into $160,000. This longer timeline shows how the interest rate makes a big difference. Higher returns mean faster doubling. Keep in mind, 8 to 10% per year is roughly what a diversified stock portfolio has historically returned. Of course, actual yearly returns fluctuate and aren't guaranteed, but for long-term planning, this gives a sense of scale. These calculations are just rough estimates. The Rule of 72 is an approximation. The exact formula for compound growth is a bit more complex. The exact formula for compound growth is basically your starting money times 1 plus interest rate raised to the power of the years equals your final amount. But the Rule of 72 gives us a shortcut without all that math. Here's what matters. If you want $10,000 to grow into $160,000, it needs to double 4 times. The higher your return, the faster those doublings happen. At 8% a year, it takes about 9 years to double. That means in age 30, $10,000, age 39, $20,000, age 48, $40,000, age 57, $80,000, and age 66, $160,000. That's the power of compounding, your money quietly multiplying over time. If you're getting value so far, do me a favor, hit like and subscribe. We keep sharing finance and wealth building strategies like this, and we don't want you to miss out. Let's continue. You might wonder, what if the returns were slightly higher, or if you add a little extra money along the way? Both of those can drastically improve your outcome. For instance, if you could eke out 10% per year instead of 8%, you'd reach $160,000 sooner, in about 29 years instead of 36. Or if you deposit deposited just $1,000 more each year into that investment, your balance at the end would be significantly higher than just letting the original $10,000 sit. Adding contributions accelerates growth. Even small monthly contributions can add up dramatically with compound interest. Another thing to consider is inflation. A key point for beginners is that $160,000 in 30-plus years won't have the same buying power as $160,000 today. Inflation erodes value over time, historically around 2 to 3% per year, so the real value of that money will be less. But the core idea remains the same. By starting early and letting compounding work, you can grow even modest savings into something substantial. Also remember, the rule of 72 assumes a consistent interest rate. Real-world returns will fluctuate year to year. Some years might be up 20%, others down 10%. But over long periods, these ups and downs tend to average out, and compounding keeps chipping away. We should also touch on risk. Higher potential returns usually come with higher risk. Stock investments can deliver approximately 10% average returns, but they're volatile. Your investment might go down before it goes up. Safer investments like bonds or savings accounts pay much lower interest, maybe 2 to 5%, so compounding is slower there. If you put $10,000 in a 3% savings account, doubling time is 72 divided by 3 equals 24 years, so you'd hit $160,000 in about 96 years, which likely exceeds a normal lifespan. That's why many investors take on some market risk for the growth potential. Diversification, spreading money across stocks, bonds, etc., can balance risk and return. Another practical factor is fees and taxes. If the investment has fees, those eat into your returns and slow growth. If you have to pay taxes on capital gains or dividends each year, that also reduces your effective compounding rate. Using tax-advantaged accounts like a retirement fund or an HSA health savings account can help the money grow more freely, but that's more advanced. The main takeaway for a beginner is the higher your net return and the longer you leave your money invested, the more dramatic compounding can be. The rule of 72 is great for quick estimates, but if you want exact numbers, you can use the compound interest formula. It works like this. You take your starting amount, multiply it by 1 plus the interest rate, raised to the number of years you invest. For example, if you invest $10,000 at 10% per year for 30 years, the formula gives you about $174,000. Using the rule of 72, we estimated around $160,000 in 29 years, which is very close. Another example, at 8% for 36 years, the formula gives about $160,000, which also matches. This shows the rule of 72 is a reliable shortcut. To sum up, turning $10,000 into $160,000 is a matter of time and a reasonable rate of return, thanks to compound interest. By using the rule of 72, we can quickly see that at around 8 to 10% annual growth, our money doubles every 7 to 9 years. 4 doublings of $10,000 gets us to $160,000. In real life, an investor who starts with $10,000 and leaves it invested for 30 to 40 years could see it grow to that size, even without adding more money. The real lesson here is the power of starting early and letting compounding work its magic. If you're new to investing, don't be intimidated by the numbers. Even small savings can grow significantly over decades. Remember, the best investment horizon is the one you have, and time is your greatest ally. By reinvesting your earnings and being patient, your money can grow exponentially. Thank you for watching, and I hope this breakdown helps you understand how compound interest and the rule of 72 really work. Keep learning and investing wisely, and you'll see how even modest amounts can grow into substantial amounts.